Hello, hello. Welcome out to the Traders Market Intelligence Report. My name is Tony Benson. I am filling in for Rob. He asked me to fill in. I believe he's traveling or something. Don't know. Don't care. He asked me to step in and help him out. I always say yes, unless I absolutely can't. So, mainly because I just love doing this. So, let's get the disclaimer out of the way. I am not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. All right, we're going to take a look at the S&P. I'll give you my broad market perspective. Some of you may or may not like it. Rob's a lot more bullish than I am, and some people accuse me of being negative, and I'm not, but that's what people choose to see, so fine. I just look at the overall market and the overall economy, and I see what I see, and I can't control it. I can't do anything about it. The only economy I have control of is my own personal one. And if the market's going to take a dump and go down, then I want to take advantage of it. If the market's going to rage up, I want to take advantage of it. I don't care which way the market goes. That's the beauty of trading. We don't have to care which way it goes. Am I bullish on this market? No, I'm not. People are like, well, we're hitting all-time highs. Okay, so we did that in 97, 98, 99. And then what happened in March of 2000, April of 2000? The bubble burst. Okay? Is that going to happen again? Don't know. I did actually hear a guy yesterday say on TV, it was interesting to hear his perspective, that the whole AI thing coming out last year, kicking off, he compared it to 1995 when Netscape came out with the net, right? When the internet was introduced. And that's what created all this excitement because everybody goes, hey, this new thing is going to completely change our lives. And for 5 years, the market went crazy. Companies that started that had no business really were launching. And ultimately, they ended up dying. But the market, as you probably have heard, can stay irrational longer than you can stay liquid if you're a bear, right? And being short-term traders, again, I don't care which way the market goes, whether it's up or down. If it looks like, if I get a pattern that looks like it's going to go bullish, if it's going to break out to the bullish side, I'll jump on it. I've got one from my weekly whispers this last week. The rest of them are all bearish. So no matter which way it goes, I don't care. I'm looking for a pattern. I'm looking for it to break out. Up, down, makes no difference to me whatsoever. But since we're talking about the overall market, I'm going to give you my macro view and what I think. But it was interesting hearing that analogy because I've analyzed I don't know what the word is. I've compared this market to the end of the dot-com. I think the AI thing is a lot like the dot-com, and it's overblown. People have gotten too excited. They've run the market way too high based on this technology, which does look phenomenal, and it has had some serious impact. But I think at this point, it's a little overblown. Just like the dot-com thing was. A lot of companies survived the dot-com bust. They're still around, right? But a lot of them went away. The question is AI the same as dot-com? And if it is, then we have a bubble building that is eventually going to burst because I don't think the AI phenomenon is going to hit. .com was awesome in 95, 96, right through up and through the 2000s, but it was still too early, right? It was still too early in the .com era to build out some of these companies. There was Webvan. Some of you may remember it. I don't know how long y'all have been trading. I started at the peak, right as the bubble was bursting. The bubble was popping when I started. Webvan was the company that came out and was going to be the grocery delivery service of the future. And they had one of the biggest raises. I think it was $800 million they raised. I think it was the biggest one in history up to that point. And they launched, they bought all these trucks, they put all this money into infrastructure. And from everything I've read about it, there was an audiobook I watched that talked about the whole thing, that whole situation. And they did everything right. They built the website, they did this. The problem was they were really too early. The technology wasn't there to really roll out that type of service. Now we have that, right? You can get McDonald's delivered to your house. You can get just about anything you want delivered to your house. I mean, there's people adding delivery services to get anything. You can have them pick up something from one private party and deliver it to you at your house. There's OfferUp and Facebook Marketplace and some of these places. They're hiring basically Uber drivers to do these delivery services between private parties. Instead of using UPS or FedEx, you can pay some Joe Schmo off the street that whatever he wants to charge. So there's lots of that stuff happening now, but 25 years ago, we didn't have phones in our hands. We didn't have cell phones. We didn't have the internet wasn't as powerful as it is today. So great business model. They had everything right, but they were just way too early. And I don't know if that's going to be the same case with AI. Only time will tell. But to me, it seems like it's a little overblown. Because the crazy thing is, my texting can't even be accurately corrected. In fact, it's gotten worse than it was just 6 months ago. It used to automatically capitalize an I. If I type I and it's sitting there by itself, it used to capitalize it. Now I have to go back and put the thing there and then I have to correct it. It's kind of annoying. Because if AI is so great and wonderful, why can't it do my texts? Why can't it fix my texts? I just... Self-driving cars? Hey, get my text right first. Anyway, so I'll show you on the charts one of the reasons that I'm not fully convinced that this bullish move that we've had recently in the last 2 or 3 months is going to last. In fact, let's just jump over there real quick. We'll look at the SPX. I think that's all I'm supposed to look at, but we're going to look at a couple of those too. So there's a daily chart. This is up to yesterday. In fact, for some reason, I can't get this to update. I don't know why it won't update today's candle. So we're actually just about 15, 20 minutes, 25 minutes from the close. So the market is almost closed. I've got a meeting to get to, so I had to do this a little bit before the close. But it's not going to change a whole lot into the close, I don't think. In fact, let's take a peek at the 5-minute chart real quick. This is my window where I have all 4 of the major markets where I can just get a quick glance. I have it up on my other screen up here, just small, so I can see intraday what's happening. There's the SPX. There is today's move. So we gapped up a little bit this morning. It has just been rallying. Quick sell-off. This is the 5-minute chart, right? And we had the big rally there, so let's get back to the daily. But there you can see intraday. In the next 20, 25 minutes, it's probably not going to do much. There might be some profit taking. It dropped down a little bit here. It could rally into the close, hard to say. But we had stuff come out last night, and here's the, what do they call it? The Fantastic Seven or the Fabulous, what do they call it? I don't remember what they call it. But Meta's up 20%. They came out with earnings, said things are great, awesome, we're kicking butt, whatever. NVIDIA's up 30 points, that's basically 5%. Amazon's up 11 points, that's 4%. Microsoft's up 7. Google's basically flat. Apple was actually gapped down about 6 or 7 points, and Tesla's down a little bit. But those 4 right there, Meta, NVIDIA, Amazon, and Microsoft probably account for about 25% of the S&P. So it is those ones right there on the list, I think, account for 38% of the S&P. Which is another reason I'm a little skittish on this breakout, because you've only got the big giant, the mega caps, that are really kind of leading the way and pushing this market higher. So there is where we're at. We're probably going to close right about this spot. I would imagine we've got 23 minutes left in the market. So either way, it's going to be a bullish day. So long term, this thing looks bullish, right, at this point. So if we look at, there's the SPX, all-time highs. But here's where it gets interesting. I would expect actually a pretty decent retracement. These types of rallies just don't go forever, right? I mean, this is a very steep acceleration. In fact, when you go back, you look at that compared to a lot of these other runs. I mean, even after the COVID crash, the massive crash, we had a run. We still had some, little slowdowns. This huge rally before it settles down, right? And I always use the analogy: if you climb a cliff, right, or if you're sprinting up a hill, the steeper the hill is, the faster you run, the sooner you're going to have to take a breather, and the longer you're going to have to take a break, right? Markets get tired too, just like we do. And so a sprint up this steep of a hill, and we took a nice little break here. And then we've popped up again. And maybe we'll keep going for a little bit, but at some point this thing's going to have to breathe and rest and take a break. I mean, I guess it doesn't have to, but it could keep going. I think the odds are significantly higher that a pullback is coming sooner rather than later. And as a trader, the only thing I care about is the odds. I'm always looking at things through the lens of odds. What are the odds of it going up versus the odds of it going down? I think the odds of it going up here, it actually, consider we're missing 60 points more today. You can't see there, right? For some reason it won't update. But the odds of a pullback are significantly higher than a continued rally, in my opinion. So, and again, I play the odds. So I am, for the most part, on the sidelines right now, just waiting for something a little more significant, a little more definitive, to give me some idea of what we're doing here, whether we're going to continue rallying or go down. I'm looking for a pattern. I'm waiting for some pattern to develop. And unfortunately, I might have to wait for a bit. Now, with that being said, I know this is supposed to be short, and I'm going to keep it as short as I can. For those of you that aren't familiar with the old Dow theory, Charles Dow was an analyst years ago. He did a lot of technical analysis. He was one of the originals. That's why he's got a lot of theories that still hold today. And the old one, you see here, I've got 2 on the list, Dow Jones Industrial, Dow Jones Transports. And the Dow theory goes like this. If one of those indexes breaks out and the other one doesn't, the breakout is suspect. Because the industrials, right, which are manufacturing companies, the GEs, the Honeywells, those types of companies, right? They're manufacturing goods. Those goods have to get to the market. They have to be transported to the market. So if people are buying products and they're being transported to the markets, the transporters are getting paid. They're making a profit, right? That means the manufacturers are also manufacturing products. Consumers buy, manufacturers manufacture, transports transport. The industrials and the transports are connected. They go hand in hand. One slows down, so does the other. One is doing well, so does the other. So if the industrials breaks north and the transports do not, that's a red flag. Now, UPS is laying off 12,000 people. They just came out with earnings. I think it was, and they didn't do well. FedEx has had mediocre earnings. They came out and said their package deliveries are down. FedEx and UPS are both shipping less. Yellow just went under, right? They laid off 30,000 people, and they don't have anything. I mean, somebody will pick up that slack, but the transportation industry is not doing that well. Now, the tricky part with this is the industrials. You look at the Dow 30, I don't know what's actually in the industrials versus, I don't know if it's the Dow 30 or if it's still industrials or not, but I think it's the Dow 30 is what this is considered. I probably should double check that, but the Dow 30 is a wide thing now. There's drug companies, there's Apples in there, tech companies. It's no longer just industrials. It's probably 10 or 20%. It's probably only 3 or 4 of them are industrials, manufacturing companies, Honeywell, GE. I don't know what else is in there, but you can see, Sal, the industrials is breaking out to a high, but look at the transports. It has not. That's what I question is, okay, if the industrials are not really industrials anymore and the transports, are they really linked anymore? And I need to double check that and see what the industrials actually is made up of, if it's the Dow 30. That used to be what it was. The Dow Jones Industrial Average used to be the Dow 30, same thing, just different names. But I need to double check it. Either way, I don't worry about that because even if they're not connected, here's the one thing that I do look at that is disconnected. This is the Russell 2000. If you're not familiar with it, if you know me, I've been harping on this for actually a couple, 3 years. This is 2,000 of the small caps companies, right? So you got the SPX, you got the Dow, and you got the NASDAQ, all 3 of the major markets that all have the big boys in there, right? They've got some of these others, but the Russell is small cap companies. And I'll never forget when I started in 2000, the dot-com bubble burst. It was a bear market. All my coaches were bullish because we had a raging bull market. And I bought the dip, and ended up blowing up my first account because I didn't know how to trade the bearish. Nobody had seen a bear market. Nobody had experienced a bubble bursting like that. Right? None of the traders, none of my coaches had ever experienced it. They didn't know what to do. In fact, some of them got cleaned out. But I'll never forget in 01 and 02 when the market was starting to bounce back. Everybody said that. Well, the small business brings us back. The politicians were all, well, we need to give tax cuts to the small business because they drive America. And that's true. 85% of business is small business. And when small businesses are doing well, the economy is doing well. When small businesses are not doing well, the economy is not doing well, right? The big businesses, the big boys, it's the old analogy between the aircraft carrier out in the middle of the ocean and the little fishing boat. If you're in a little fishing boat and a storm starts to kick up, you better run for shore quick. The big aircraft carrier, the Microsofts, the Amazons, the Googles of the world, the Metas, they've got tons of cash. They got this huge, giant ship. Not only does it take a lot of time to turn it around, but they can withstand a massive storm, right? Where those of us little guys in the rowboat have to get the heck out of Dodge as quick as possible. So, the big boys are healthy because they've got tons of cash. And they can invest in the new stuff. They can do that, but the little guys, not necessarily. And if you look at the Russell right here, I'm going to go back a little historically, and this is one of the reasons, because 22 for me was my best trading year yet. And part of it is that I was bearish in here. Here's the Russell, right? And there's the COVID crash. Boom, it rallies back, takes off, it bolts to the upside, and then it just starts going sideways at the end of 2020 all the way through 21. It just bounces between 2130 and 2350. Now, if we do a comparison and we put the SPX on here, you can see right about here where the Russell peaked and here where we had the false breakout, you see that purple line? That's the SPX. It's still raging north. While the Russell is slowing down and he's going, wait a minute, maybe things aren't as good as we thought. The small businesses are starting to slow down while the major markets are still going. And then what happened? Right? In 22, this thing turned and the major markets caught up with the Russell. The Russell had a false breakout here and then turned over and started dropping. And then the rest of the market caught up. And then you can see they're pretty much going in tandem. And then here in February of last year, the SPX started to outperform and started to go higher. The Russell stalled a little bit, but then finally caught up. They both dropped off. This is where I thought we were restarting the bear market. We had a head and shoulders on the SPX, the Russell, all four major markets we had a head and shoulders. Beautiful pattern. Everything was lined up. It looked like it. It broke. It dropped off. Everything was money. And then Powell comes out and says, oh, we're going to stop raising rates. And that's where everybody got excited and said, oh, he pivoted. And then the market raged north. Because the last few cycles, when the Fed pivots and they stop raising rates, that's when the market turns around. So the market has figured this out. And now they go, oh, it's time to go. So they started jumping on board. And you can see that the Russell rallied too. But notice in the last few weeks, it slowed down. It actually had another false breakout. You see the SPX slowed down a little bit, so did the Russell. But it's pulled back and it's stalling here while the SPX has made a new high. But the one thing to notice, okay, and I'll wrap with this, is notice that time period we went sideways. And then we had a breakout here, which turned to be a false breakout. It dropped back down. We have another sideways move in the Russell, a breakout above 2,000, but it only stayed there for a very short time. The Russell is still, we're at 1970. Actually, this is kind of sort of real time. We're at 1971. The high of this was 24 and change, 24.50. We're still 20% below the high on the Russell. So the SPX, the Dow have broken out to new highs. The Nasdaq's close. It hasn't quite. It's within, I think, 5 percentage points of hitting all-time highs. Russell's still 20% below. What does that tell us about small business? They're not doing that well. And if this is what drives the economy, 6 out of 10 new jobs are started, come from small business. In fact, I know a couple people in the area that work for small business, 150 employees, which in the big scheme of things is small. They laid off 10%. REI is not a big company. They just laid off 10% of their staff, or they're starting to. A lot of layoffs are starting to take place, which can be good for bottom line profits. But those dominoes start to fall and it trickles down when people can't pay their bills, then there could be a storm. Maybe there won't be. We don't know, right? A lot of people expected it last year. But this right here is a massive clue to me that says, watch out, because we don't know what's coming next. Little guys are not really doing that well. So be cautious. Trade short term. Yeah, we're looking at the SPX. The markets are looking bullish at this point. The charts are. But just be aware that just because it looks good on the surface, there's a lot of underlying stuff going on too. That when it comes to a head and reality settles in, that it could get ugly. And we don't know, right? That's the challenge of trading. We don't know what's coming next. All we have to do is look at what we see and analyze it and say, okay, this is what I expect. This is what I see. Here, my macro view is that this is a false breakout. I don't think the market's going to keep going up. I think something's going to happen. The data is going to finally trickle in. There's already a bunch of underlying data. Manufacturing is not doing well. The LEI, leading economic indicators, has been negative 21 months in a row. The record for that indicator, which has been around for a long time, is 22 months in a row. That was back in 2008. 22 months in a row, it was negative. We're at 21 months right now. So if next month is negative, we tied the record for the most negative months for leading economic indicators that are showing a recession coming. Same thing happened in 2008, right? And people did not see it coming. So just be cautious. That's really what I'm trying to get at is I know it's exciting. We're hitting all-time highs. Things look bullish. It looks great if you're a bull. And frankly, I don't care which way the market goes. Just move. Give me a pattern. Give me something I can trade. And whether it's going up or down, I'll trade it. But from a big picture perspective, be careful watch out for a black swan, I guess is the best way to put it. So, all right. Enough said. I think I've rambled on way longer than I was supposed to. So I hope you're all having a great weekend. And I suppose you'll see Rob next week. Y'all take care. God bless. Bye-bye.